Trendlines are one of the most basic tools in technical analysis.
Trendlines.
But if you don't know how to use them properly, they can completely wreck your trading strategy. Most traders either draw too few or way too many. Before you know it, your chart looks like a bowl of spaghetti. Confusing? Absolutely. There's actually an art to drawing trend lines that truly matter. And today, we're unveiling a spanking new indicator we built that automates the entire process, from detection to execution, with cleaner, smarter results than anything you've seen before. So if trend lines have ever tripped you up, this one's for you. What are trend lines really? At their core, trend lines are simple. Just diagonal lines that connect price points on a chart to help identify the direction of the trend. But drawing them properly, that's where things get tricky. To draw a valid trend line, you need at least 2 clear touches from price action that show respect for that level. The more bounces a trend line has, the more traders recognize it, and the stronger it becomes because every bounce is another vote of confidence from the market. Now, here's what most traders don't realize. It's not just about slapping one line on your chart and calling it a day. There are actually 3 types of trend lines you should be tracking: long-term, medium, and short-term. Each plays a different role in your analysis. And more importantly, each gives you a different type of signal when broken. Trend lines are often used to catch breakouts or retests, 2 of the most common entry strategies in trading. And depending on which type of trend line is breaking, the strength of that signal can vary dramatically. This indicator takes all the guesswork out of drawing trend lines. It automatically detects and plots all 3 levels on your chart, each styled differently so you can instantly tell them apart. The long-term trend line shows up as a solid line, acting as the structural backbone of the market. The medium term is drawn with dashes and is the broader trend within that structure. And the short term appears as a dotted line, reflecting the most recent price action shifts. The logic behind this is powerful. When a short-term trend line breaks, the market often gravitates toward the medium-term line. If that one breaks too, momentum typically carries price toward the long-term trend line, which is usually the strongest and most respected of the 3. To make this even more actionable, the indicator also detects bounce reactions. When price touches one of these trend lines and shows signs of holding, you'll see a blue dot for an uptrend bounce and an orange dot if the bounce happens during a downtrend, allowing you to easily see potential entries. Now, when we dive into the settings of this indicator, you'll find full customization at your fingertips. You can adjust the period so the trend lines reflect data from higher time frames, making it perfect for multi-time frame analysis. You can also control the swing length, which determines how many candles need to be higher or lower than a swing point for it to qualify. There's even an option to display the higher high and lower low swing points directly on your chart, giving you a visual map of market structure. And if you like visual clarity, enabling the bar color feature will color the candles based on the trend direction of your selected term, and you can activate a background color that reflects trend bias as well. When a long-term trend line is broken, the background of the chart and the candles themselves will shift color, instantly signaling a major change in market sentiment. Once a new higher high or lower low swing is confirmed, the indicator initiates a fresh long-term trend line. It starts at the extreme point, the highest high or lowest low of the previous trend. But that new line doesn't immediately snap to current price action. It waits, plotting horizontally until a significant swing is detected, and then it will be adjusted. It represents the boundary of the previous trend, and as price action continues to evolve, you'll see the medium-term and short-term trend lines begin to take shape between those long-term pivots. This structure gives you a layered contextual view of the market, where price has been, where it's likely headed, and how strong the directional momentum truly is. In this example, we're working on the 30-minute time frame, but we're going to set our trend lines to be based on the 4-hour chart. This gives us a higher time frame perspective, which is key for spotting stronger, more reliable trends. Now, just by doing that, we instantly get a clear sense of the market's directional bias. The background is green, so we're in bullish territory and should be looking for long setups. But we're not just going to randomly buy. We're going to wait for a short-term bearish trend line to break. That signals a potential continuation. Once the break happens, we can place my stop just below the most recent swing low and set the initial target at the bearish medium-term trend line. That gives me a clean, structured plan to follow. Now, here's something to keep in mind. Since we're using higher time frame levels, those trend lines can actually update while the trade is still open. If a key level shifts mid-trade, We want to exit as soon as that updated level is reached. This keeps the setup dynamic and ensures we're constantly adapting to current market conditions, rather than trading outdated signals. But let's look at a different example that shows how this indicator can help you ride the trend a little longer with confirmation. In this case, we can see a bearish long-term trend line was broken, and right after that, a new bullish long-term trend line is plotted. That's our signal to start shifting our mindset. We're now looking for buying opportunities. At the same time, we notice a short-term bullish trend line was broken. And like we talked about earlier, this often means the market will start moving toward the next trend line. In this case, the long-term bullish one. Sure enough, price gravitates toward that area, and we get a blue dot signaling a bounce is detected. But instead of jumping in right away, we're going to wait for confirmation. Specifically, we want to see the bearish short-term trend line break. Once that happens, we've got alignment. I'll place my stop just below the point where the bounce was detected, and my target, one of the major highs on the chart. Once the medium-term trend line is broken, I'll move my first stop to break even and add a second position to this trade. From there, it's all about letting the trade develop, adjusting my stop as the market trends and protecting gains along the way. The indicator we use today is called the Trendline Breakout Navigator, and you can get